Good morning, and thanks for joining us. Today is Wednesday, April 19th, 2023. We have some earnings updates today. We have some information across the pond. Some central banks, again, continue to be in focus. Whenever Jim Bullard speaks, Tom, he makes news and because he likes to come out with out of consensus views and things that really push the envelope in terms of where the Fed is thinking, but it does have an impact on markets. This is really, we're going to touch a lot on earnings reports today and kind of macro themes, but this is really just a warm up act because tonight, Mo, and into tomorrow morning, we have a lot. We have AT&T, Philip Morris, Union Pacific, DR Horton, the home builder. Are there any investments, any stocks that you're particularly interested in over the next 24 hours?
DR Horton's up there just to see where construction is and housing starts. I'll look at AT&T because I do like telecom just in that sector, but I would say DR Horton's probably one where it's going to be an important gauge to see where the home builders are at right now.
Yeah, we're increasingly favoring T-Mobile, and
yeah,
Mo actually was the one who has been leading the charge on T-Mobile and really identified growing free cash flow there. Do they report next week?
Yeah, so they'll report the week after. AT&T's this week. I think Verizon's following. So they're kind of staggered just a bit. Going into AT&T, I do think AT&T's might be a little bit positive. They've had some good postpaid net adds quarter over quarter. So I think the expectation is pretty good there. It just seems like both AT&T and T-Mobile are just taking market share away from Verizon at like a very rapid pace. So definitely have catalysts there for the two of them.
Interesting. On the financial side, we did get results from a few of the regional banks last night and into this morning. Western Asset is probably Western Alliance, WAL is the symbol on that. They're up 19% pre-market. They saw a big outflow in deposits. I'm showing down 11% on a quarter-over-quarter basis in deposits. So that's end of March compared to end of December. And that came even as they had to really juice the rate they paid on deposits. The rate they paid on deposits went from 1.97%, which was on the high end of the industry, to 2.75%, which is the highest of any bank that I'm following right now. In fact, of the US focused banks, so I'm excluding Citigroup on this, Western Alliance is the only one that's above 2% right now. That increased of the deposit rate by 78 basis points in the quarter. Again, the best performers were Bank of America at 40, JP Morgan at 48, and Western Alliance at 78. Citizens Financial also reported this morning. They saw larger than expected draw on deposits than I thought they would see. They were down about 5%. And I think this kind of speaks to who are the customers of these banks, because you saw First Horizon, which was only down 3%. This is a very small regional bank based in Tennessee. They're down 17% on a year-over-year basis. So clearly investors wanted to take their money out, but it's not really any more than the trend because, again, Southeast focused, a little devoid of the big in the Northeast and on the West. So you're seeing a little bit more stability in those banks, which probably bodes well for the likes of Regions Financial as they report on Friday morning. So I'm curious to see what happens with that, Tom. And any thoughts on this? I mean, I think this speaks to the underwriting that we've done on Regions. Obviously, we really messed up the timing on that, timing it with a regional banking crisis, but it does go to show that you can have some element of store value in some of these banks.
Yeah, I think it's just not every bank is equal. They all do different things. They're all in different regions, no pun intended. And I think Regions has a real foothold in the Southeast. I mean, it's the official partner of the SEC, based in Birmingham. And if I could think of a city that's could not be more different than Silicon Valley, I would say Birmingham. I don't know if anyone's been there recently, but it's definitely not the tech hub of the world. They do have a Buc-ee's though, so they're moving up in the world. But I still feel pretty good about Regions. I think they're going to do well. I'm excited to see their results, but I think that staying away from a lot of tech exposures and just being, boring, dusty good old boy network of old school bankers is probably the place to be right now, because they've been in business a long time. There's a reason they've been in business a long time, and it's not some startup or some go growth bank. It's they make their money every year in, year out. They don't do anything wild because they just want to continue to operate, which I think is a smart way to play it right now.
On the semiconductor side, we did see results from ASML, which is a Dutch-based semiconductor equipment company. And in contrast to some of the others, they're actually continuing to see growth, but they have a little bit more of a stronghold in EUV, which is kind of the next generation for, as you miniaturize semiconductors, you need different technologies to be able to do that beyond just shrinking the die size on these semiconductors. So EUV is the way to do that. So ASML is actually down 5% though, because bookings were extremely slow. This is a very lumpy business, and it speaks to the reticence of a lot of companies to invest right now. Taiwan Semiconductor, again, in the news, talking about cutting capital spending. We did have news on Abbott, which is the company that produces the baby formula, had all those issues, Ensure, Pedialyte. But they also have a lot of medical devices, and that's really their big business. Part of that is in diabetes. So they have the Freestyle Libre product, which grew 50% in the United States. They upped organic growth guidance for the quarter. Overall, it was probably the best quarter I've seen from Abbott in quite some time. They've just been so focused on the COVID testing for a while. But it does seem like procedure volume is improving. And I was impressed that nutrition actually, that the baby formula piece grew, pediatric nutrition grew about 18%. Again, extremely easy comp, because last year, this time, they'd shut it down. So, and I still think there's some big lawsuits that could come as a result of that. And then finally on Netflix, Netflix reported earnings last night. And I think what we're seeing with Netflix, I don't even know if stock's down or up right now, because it was down 10% at one point, and then it was up.
It recovered a bit.
Basically, subscribers came in light, earnings guidance was light, revenue guidance was light, but free cash flow guidance was raised positive. And ultimately, that's their goal right now. They've shifted what their key performance indicator is. And I think targeting free cash flow right now is probably the most appropriate thing you can do when cost of capital goes up. You want to husband more cash. And I think that's what Netflix is doing.
That's the
Mo, do you have any thoughts on this?
That's the trend we've seen across the board with these streaming companies, is that they're moving away from, trying to grow subscribers as quickly as possible and, take market share away from each other, and now just focused on profitability. I mean, we've seen that from Disney Plus, we've seen that from Warner Bros, and now we finally get to see that from Netflix. And I like the move. I mean, just growing your subscriber count, not focusing on the profitability, you dig yourself in a pretty deep hole and it's hard to get out. And they're finally realizing it. So I'm all for it.
Do you think that this is a read for some of the other streamers like Warner Brothers or Disney or Paramount?
I think they're starting to understand their consumer base, and I think that they're starting to look internally and just focus on that profitability instead of just going to war with each other. I don't think that's benefited any of them. I think analysts are liking it. They got an upgrade this morning. So I thought they had a good quarter.
Yep. Across the pond, UK CPI, Tom, coming in higher than expected, still down, but really, counting pennies there, or pence, as they would say. Month over month inflation falls to 0.8% from 1.1%, but we're looking for a decline down to 0.5%, which would still annualize at 7%. The core year over year number remains steady at 6.2%, so no relief there. So real issues for the UK, even as they were the first ones to start raising rates. They haven't raised as aggressively as in the United States. And they also have more structural problems because it's more service related economy. And they also are more price taker in some of the oil and gas space. So UK having issues, and I don't know what they do there. I mean, they just raise rates until it breaks.
I mean, they're projected to have one more rate hike, maybe 1.15 sometime in the next 3 months. And then they're expected to also start cutting, as far as I can tell from the chart here. So the question is, I mean, what do you do at 10%? I mean, they're in a tough spot because they it benefited them during COVID to be to have Brexited, to be separate from the UK. But now they're dealing with the fact that they're an island nation. They don't produce any of their own goods. Obviously there's been a run up inflation on almost everything. And then you've got on top of that, the service element of it. So I really don't know what the playbook is for them. I think there's a certain degree of sort of the traditional British economic spirit, which is, sort of grit your teeth and get through it. I think that they're not going to be in a position where they can just raise rates to the moon and crush this thing in the same way that we can, because it's just fundamentally different. We have a million different types of produced goods, services, huge land mass. It's just a totally different animal. I'm not quite sure what the playbook is there, but it doesn't look good for the UK right now. And even when we looked to yesterday on the fund manager survey, the most underweight area is the Eurozone in the UK. And I think that's probably the smart move for the time being.
I mean, you look at some of their biggest industries and it's financials, insurance and banking, which are not in good spots right now. And then you also have healthcare, which should be in a good spot with pharmaceuticals. But I do wonder if the likes of AstraZeneca and the likes of GlaxoSmithKline, if they're starting to get out innovated by some of what the United States and even mainland Europe manufacturers are doing. Novartis just had a big cancer drug move through the pipeline. You see Novo Nordisk making moves with its diabetes push. And you just have these big legacy British companies that aren't moving the ball forward, and they need to get that going. So I'm curious to see what happens there. But the wages are also kind of pinning them in, because you're going to have to pay a higher cost employee base. So it'll be interesting to see what happens there. Domestically, talk about Jim Bullard, Tom, because he says that there won't be a recession in contrast with the Fed staff, and doesn't really think that bank issues have tightened financial conditions that much. So he says we need to raise rates more.
I worry about this. We talked about it yesterday, that we're starting to shift back towards more interest rate hikes, just in terms of the way the yield curve is moving, the way bonds in general are moving. And Jim Bullard jumped right on top of that yesterday afternoon and really splashed the pot, as they say. But he basically said they need to raise interest rates between 5.5 and 5.75, which is a little bit higher now than we're projected by a number of hikes. And he said, quote, Wall Street's very engaged in the idea there's going to be a recession in 6 months or something, but that isn't really the way you would read an expansion like this. The labor market just seems very, very strong. And the conventional wisdom is that if you have a strong labor market that feeds into strong consumption, and that's a big chunk of the economy, it doesn't seem like the moment to be predicting that you have a recession in the second half of 2023. I mean, I get that, but the data he's looking at is not indicative of the most recent data, in my opinion. We talked about yesterday that there's a strong potential that we could see a negative jobs number sometime in the not so distant future, at which point, we're moving in the opposite direction.
I mean, the Fed's own projections would imply that.
But I mean,
3 million.
I'm not quite sure why he feels that way, but if they continue to raise rates, we will have a recession. And we discussed this a bunch yesterday during our investment committee meeting, kind of getting a read for where everyone was on the recession. And my thinking is it's fully dependent on what the Fed does. If they raise one more time, pause, hold it there for a while, I think there's the potential that we'll have more of a rolling recession, which is different areas of the market get hurt at different times, which is kind of what we've already seen as a result of the Fed raising interest rates. But I think that if they continue, if we really get to 5.75 or even potentially higher on the interest rates, we're going to have a very strong economic slowdown. And it's not just going to be one area or another. And if you look back to last summer, there was sort of a retail recession, and by the letter of the law, we had a recession last year. We had 2 consecutive negative prints, and that was led primarily by all the inventory issues that came on the back end of all of the supply chain issues. And so, maybe it was just enough pieces of the economy were in recession last year, and some of them weren't. And now we're going to be in a position where different parts this year are going to be in recession, and some of them won't be. We'll probably maybe have a retail rebound because they've gotten lighter on inventories. We've seen the trend going that way on ISM. So I think it's dependent on what the Fed does. And I'm worried now that the Fed sees a little bit of momentum and they're going to think they need to continue to be very strong, when in reality, we're probably just now getting the results of all of the aggressive rate hikes from last year filtering through the jobs market, filtering through the economy at large.
Yeah, I mean, and I think that, GDP is going to be helped out a lot by net exports. Net exports is a positive for the economy, but net exports means exports minus imports. So the reason net exports are going to be doing well is not necessarily exports are going to be strong. It's imports are going to be so light. JB Hunt talked about that, but there are places in the economy right now that's in recession. I mean, I would say oil and gas is in a modest recession right now. Freight is definitely in a recession. Financial services in a recession. Like, look at the deposits, look at the loans, look at the mortgage originations. I mean, if you're in those businesses, that's recessionary. Your income is going to be lower this year than it was, or in this quarter than it was last year.
I mean, our weekly mortgage applications this morning was down 8.8% week over week. I mean, that's a big move for 1 week.
So, I mean, I think ultimately we have that now. The question is, to Tom, to your point, does it manifest in a broader economic slowdown? Let's just finish up with earnings coming up. Tom, and we talked, Mo, about DR Horton and AT&T tomorrow morning. I'm very interested in Tesla tonight and American Express in the morning tomorrow. I think those are going to be some really interesting earnings reports. I think Tesla could be down 20%. It could probably also be up 10%. But I think you could be setting the stage. I mean, Mo had to test drive a Tesla and didn't very much enjoy it.
It's not a fun week.
So I'm curious to see what happens with that.
UNP will be interesting as well.
UNP will be interesting. I'm very interested in American Express because of what's going on. I think it might hold up fairly well. We do think that American Express is a relatively attractive financial here, to the extent that we want to own financials. Tom, what are you looking for?
I mean, Tesla's a big one. I just think it's an interesting story, and I think it really shows the way it reacts is going to show the way the retail investor is thinking, right? Because Tesla was very much the staple stock of the retail investor that was chasing the market at the all-time highs. The person that was in Bitcoin, the person that was in GameStop. I saw an article over the weekend. I want to say it was in Barron's. It said the average retail stock picker is still down 27% from the high in 2021, which means that they were either highly concentrated or all in bad stocks or both. And Tesla's really taken the brunt of it. I mean, they've taken a big hit from a valuation standpoint in the last couple of years, but I don't necessarily think that makes them a less attractive company. I think they're actually moving closer towards valuation that I think is interesting. But the vehicle market is so strange right now, right? We're starting to see a reacceleration in prices, but I think that we're probably going to see a big drop in prices coming on the back of the Fed rate hikes. I think that, they've been aggressively cutting prices while other companies have either been raising prices on their electric vehicles or unable to even complete the production process on them at all. So is that demand flowing to Tesla? Is there a bad taste in people's mouth because of the Twitter acquisition? There's just so many moving parts to Tesla, and it has potential for explosive upside or explosive downside. And the question is, are they going to hit the right number that's going to make, those retail investors that get behind Tesla and really drive that hype train? Are they going to get them excited? Are they going to get, more institutional investors excited as well? So those are the numbers that are really going to play heavily in tomorrow. And it's a big chunk of the S&P 500 still. It's over 1% still.
The big moving number, if you want to follow Tesla on your own, look for this commentary. They need to increase production and deliveries by 50% this year. That's their guidance. If they come short of that or don't reiterate that, stock's going to have some trouble.
And they cut prices last night.
They did
again by about $3,000 each. So
you now get a Model 3 for less than $40,000 for the first time in years. So on that note, we will see you tomorrow morning. Have a great day. And we'll touch on all these earnings reports in the morning. Bye.